Yeah. Question. Everything's in question. Yeah. The early final? No, it's in 170. Yeah. Yeah. 11:15 to 1:15, 170. Yeah. Okay, folks, welcome back for the last time. So, couple of things. One is, reminder on the two final exams. The regular final exam is next Monday. I've had 2 times sent to me by the administration. One said 10:30, 12:30, and the other said 11:15 to 1:15. They've told me it's 11:15 to 1:15. Don't ask me why they have the strange timing. So next Monday is the final exam, 11:15 to 1:15. There is an early final if you're taking that option this Wednesday, day after tomorrow in 170. So don't come waiting here saying, where is the final? It's in 170 from 11. Now, final exams week, this room becomes incredibly difficult to get. So I had to get 170. Should be plenty of room. I think 60 of you or 55 have signed up. If you feel you're not ready, don't worry. Just pull your name off. Just come for the regular exam. So, or if you want to add on, you feel you're either way, let me know. Okay. Your project is technically due by 5 p.m., but if it comes at 5:30, 6, 6:30, 7, 8, I'm not going to say, look, it's late. I'm going to take points off. Get it into me as soon as you can for your own good, because as long as the project is hanging over your head, you can't get ready for the exam. So you want to get it out of the door. So try to get it out. And again, reminder, please send it as a PDF file. It makes my grading a lot easier. It's easier to put comments into a PDF than a Word or a PowerPoint. So even if you're prepared in PowerPoint, just save it as a PDF file. Okay? So today I'm going to actually use the numbers you turned in as the basis for reviewing the entire class. Okay? You know how when you get an email from an investment bank, and if you worked in investment bank, at the end of the email, there is this long disclaimer about all the things they will not be held responsible for. So before I show you the numbers, I will not be responsible for strange numbers because they're your numbers. I did not do any editorial fixing, even if I thought a number was strange. I think the only thing I fixed was an R squared of 3,630%, which I think was 36.30. If you really meant it to be 3,630, I would love to know how you got there, because we could write a paper in statistics, get it published, or how we went beyond 100%. So for them, I've just taken your numbers and essentially I'm going to give them back to you. But much of this class is about getting perspective. Perspective in what sense? I know when you walked into the class, if I told you a company has no debt, say, well, is that strange? Is that common? One of the things you get as you look across companies is a sense of what's typical, what's strange, what's high, what's low. So as you look at the numbers across the class, think about where your company falls, but also look at the distribution. because you're going to see 200 companies from around the world. You're going to see very different perspectives play out. So let's start with a with a very simple reason why I give this project. It's a pain in the neck. It's a lot of work. And you're saying, I wish it were a nice compact case. And the reason I think it's good to get your hands dirty with a real company is the real world is a messy place. And you found that out very quickly, right? There are very few facts on the ground. In fact, outside of the T-bond rate, and even that is debatable as a fact, everything else is kind of hazy. It's subjective. You got to make judgment calls. And in fact, when you look at different services, they give you different numbers for the same fact, right? Especially when you look at things like ratios. You look at Bloomberg's debt to cap ratio, and one of the things I hope you get out of this is never trust somebody else's computation of a ratio. P, you think, oh, everybody's got the same number. Not necessarily. It's not that you do it better, but when you do it yourself, at least you know what went into the numerator and the denominator. Second, as you went through this class for your companies, real things happen to your company. Again, a pain in the neck. I know quite a few got earnings reports on Thursday and Friday, and I got frantic emails saying, should I update everything? And I said, are you out of your mind? You want to open up that can of worms now? You know? But the truth is, if this were a real decision you had to make, you would be updating and things would be changing. And it's not just financials that are coming out. I don't think, did anybody do Paramount in this class? Okay. That would have been an interesting case study in real life, because talk about corporate governance nightmares, right? You're familiar with Paramount. Paramount is controlled by Sherry Redstone. Does anybody know how she ended up with that control? Yes. Her husband, right? Or her father or her husband? Sumner Redstone, father maybe. Yeah, father started the company. Not really started the company, but it was the old Viacom in the 1980s. And Viacom issued two classes of shares. And at that time, Sumner Redstone was viewed as kind of a genius. So you know what people did, right? He's a genius. What's the harm in giving him voting rights? They gave him the voting rights and control of the company. And then Sumner got older and people got surprised. He's getting older? Yeah, he's getting older. And then he developed dementia. And Sherry Redstone stepped in and made decisions for him. And then when he died, the shares went to Sherry Redstone. So now when you look at Paramount, it's a hot mess. I've never seen a company with this much stuff floating around where nothing seems to be happening on the ground. And just last week, you had a fiasco of, where Sherry Redstone pushed out the CEO that she had hand selected because she wants one deal over another because it'll make her better off, and there's nothing you can do about it. The nature of real companies is real things happen to real companies. You got to roll with the punches. It's not something that, it's not a conspiracy, but it might have felt like that the managers were conspiring to make your life difficult on this project. Trust me, you were not even on their radar. But as a side effect, that's what you saw. And finally, I did do some spoon feeding on the spreadsheets, and I did it intentionally. I did not want you to spend this entire class learning Excel, partly because it's a useless skill by itself. I mean, it's sooner or later, it's going to be something that the AI is going to do, ChatGPT is going to do. So if you mastered all the keys on the PC on how to turn things in Excel, congratulations, rest on your laurels for like 15 minutes. That moment is gone. But at the same time, I tried to tell you that they shouldn't become black boxes. And in the, especially in the last week, some of those spreadsheets became black boxes. You fed numbers in the optimal capital structure spreadsheet, it came up with the numbers. I don't know what happened there. But I'd like you to step back and remember all of these spreadsheets, all of these models are your tools. It's not the other way around. The model works for you, you don't work for the model. And I know you've already written your report, but as I read the report, if I see the word, the model came up with an optimal debt ratio of 30%, I know exactly what you're trying to do. You're saying, it's not my fault. Your model did this. I can't explain it, but you want to get over that. In a sense, if the model delivers something, or even though in this project manager, you can blame the model. At some point, you got to abandon, and this is something I see bankers do. Essentially, the model value the company at, the models are your tools, not the other way around. So when I asked you to pick a company, I let you pick whatever company you wanted. And as you look at that Google shared spreadsheet, you probably notice there are other people who picked the same company. These were the most picked companies. I don't know what it is about this Lululemon. Every year for the last decade, it shows up on there, right? It's a fixation almost, right? But it's up there. Nike, Salesforce, Starbucks, Spotify, Netflix. Other than Salesforce, notice that these are companies that you are, every day you run into them. So in a sense, what you see there is a reflection of the fact that we tend to gravitate towards things we understand. In fact, in investing, there are these studies that show that there is a local bias, that when you invest, you tend to invest in companies, not just in your country, but that are close to you, that you're familiar with. We gravitate towards the familiar. Now, somewhere in the middle of the semester, I don't know who it was, who noticed that there were three other people doing the same company, and they emailed me and said, why are you letting multiple people do the same company? Aren't you worried that they might, here's why it doesn't matter to me. There were four people who did Lululemon. There's the numbers, not a single number, not one. Okay. So some of them are pretty close, but don't take it. So if you're the 37%, you still have time. That looks a little off, right? So you might want to check to see whether there's something going on. But you can see that the numbers don't match up. Why? Partly because you don't all do things at the same time. Remember, the T-bond rate used was that I can tell when you did your project by just looking at the T-bond rate. If I see a 4.73%, you really put this off till the very end, didn't you? If you had 4.4%, you got it done probably too early because you did it in February. Again, you didn't have to use the same T-bond rate, but you can see the numbers vary, not just on your risk-free rate, but on things like the beta, when you did a bottom-up beta, the way you come up with businesses, the weights you attach. So it never bothers me when multiple people do the same company. In fact, as I read the report, I'm looking for nuance that you bring to those numbers that might lead you to a different destination. So let's go back to the very beginning. We spent the first 3 sessions of this class talking about corporate governance. And if you step back, what we're really talking about is the fact that there are multiple players and companies with very different interests. Managers have their own interests. They want to maximize their human capital, their competence. It doesn't make them bad people. Human beings are driven by self-interest. Any system that acts like self-interest doesn't matter is destined to fail. So managers have their own self-interest. Stockholders have their own self-interest. Lenders have and what you have in a company is if you don't align those interests, there will be times when one group makes decisions that makes the other group worse off. And in particular, we focus on the relationship between shareholders and managers. We talked about the fact that managers are not, if they feel that shareholders have little power over them, put their interests over shareholder interests. And we looked at lots of different things to make that assessment, but ultimately it's a subjective judgment. Keep that in mind when you see corporate governance scores. People act like, oh, the corporate governance score is high, that must mean it's a judgment call because you look at the board of directors, you look at the voting and non-voting shares, you look at the history of the company, and ultimately say, in this company, where does the power lie? That's really what I asked you to make as a final judgment. So all of those things lead up. And I asked you between 0 and 2 to give me a sense of where does the power lie? 0 being shareholders having no power, 2 being complete power. And you can see those are very tiny slices, and most of your companies fell somewhere in the middle. Some power, And so basically, the more power is the 1.5. So that was, in fact, the median, but you can see the spread across companies. When I look at your reports, I actually keep a secondary tab of US versus foreign companies. So if I can see, generally speaking, the shareholder power is less in family control companies because for obvious reasons. But you see the differences start to play out across companies. And then I ask you who your marginal investor is. Somebody, I mean, by this time, it should be, Justin, what is a marginal investor? Trades and trades a lot, right? So if I trade 100 shares every 15 minutes, I can't become the marginal investor. I can't move the price. You have lots of shares and you trade. Why do we care? Guillermo, why do we care who the marginal investor is? It's a much more pragmatic, Justin. Basically, this is the lead into all our risk and return models, right? Because in all our risk and the minute you use beta, what are you already assuming? That the people looking at this company look at only the risk you cannot diversify away, which is okay if your marginal investor is diversified. And luckily for you, 91% of the companies, an institutional investor was your marginal investor. Remember, you're not looking for a name on the institutional investor. It's not Vanguard who's your marginal investor, it's institutional investor because the institutional investors can keep shifting on you. It can be Vanguard today, BlackRock tomorrow, State Street the day after, but they're all investors who likely be diversified, which allows me to use betas. There were a few companies we had insiders and individuals in there. You're still probably going to use betas, but you're going to hold your nose while you do it because there will be times when the beta might underestimate the risk of this company. It's more like a private company, especially if you're doing, I don't think any of you picked very closely held companies where 93, 95% of the shares are held by the insider. You even wonder why these companies are listed. I think they're listed to get a market price so that the insider can go around and say, I'm worth $1 billion, I'm worth 500 million. These are really private companies masquerading as public companies. I mean, India has thousands of publicly traded stocks. I think half of them are there just to get the listing and the market cap. There's almost no float, no trading. So the reason we care about marginal investors is to get a sense of, are we okay assuming that the only risk that gets priced in is the risk you cannot diversify away? So that leads us right into the risk discussion. So if you think about it, there are two components of capital, cost of equity and cost of debt. The cost of equity, you start with the risk-free rate. No default risk long term. Now, the natural follow-up to that is let's use a government bond rate, and sometimes you can get away with it, right? What are the requirements for the government bond rate to be my risk-free rate? What do I have to assume about the government? That they will not default, right? Is that safe? In some governments, so you really think the Venezuelan government will not default? But maybe not today, but by tomorrow, who knows, right? So what that means is if you have a government where you worry about default, you have to start with the government bond rate and clean it up, take out the default risk. Second stop is the equity risk premium. The equity risk premium is the price of risk in the equity market. And before you even look at the approaches, let's put the facts on the table. The equity risk premium is a volatile number. It changes over time. Why? Because I think of equity risk premiums as that battle between greed and fear that you look at in markets, right? Sometimes greed wins, sometimes fear, and it can happen. It can change over the course of a month. Take a look at March for the S&P 500 and take a look at April for the S&P 500. March was this month where mood was great, greed was winning. April suddenly, out of nowhere, fear came back. Equity risk premiums vary across time. And if you look even at the course, during the course of this year, my estimate of the equity risk premium for the S&P 500 has moved around. And of course, if you go across countries, equity risk premiums vary across countries for lots of reasons. Countries vary. And so the whole idea of the equity risk premium is it has to be volatile and it has to be company specific. Now, of course, the way we're all taught to estimate betas is to run a regression. And regression is a terrible way to estimate beta. It's a single regression. One is purely statistical, right? When you run a regression, you get a slope of the line. The slope comes with a standard error. It's noisy. Second, by definition, it's backward looking. I can't run a regression with returns for the next 5 years. It's got to be returns for the last 5 years. And third, you can game the system. I don't know how many of you had a chance to play on the Bloomberg with starting points and ending points. Justin tried different weekly, monthly, and you get betas that shift around based on the choices you make. So as an alternative, I said, forget about an individual regression beta as the basis for your beta. Try to get a bottom-up beta. And if you don't like the way the bottom-up acronym, create your own. Basically, you build up to a beta for your company by starting with the businesses they're in, weighting those businesses and multiplying the weight by the unlevered beta of each business, which you get by looking at publicly traded companies in the space. And where do we get the betas for those publicly traded companies? From regressions, but the averaging is where you gain. So even if you're in a single business, you still get that averaging benefit. And then you can also reflect changes in the business mix. And of course, to adjust for the debt you have as a company, you can bring in your company's debt to equity ratio, which can be the current debt to equity ratio, change debt to it gives you complete flexibility. So one of the questions, yes, go ahead, Zach.
Slide.
Yeah.
The advantage of that average. You have a company that's in a industry that has like diversified revenue streams.
When you say diversified in businesses or geographies? Right. They have multiple, they're in multiple businesses.
It's not like 80% one and then it's like 50%, 30%, 20%. What can you speak to a little bit if you were just going off of the regression data, how that would impact whether positive or negative?
A single regression beta? It'll reflect the average business mix you had over the last 5 years. This is if you're lucky, and the regression beta is actually a good estimate. It'll reflect so for Disney, it'll reflect the mix that they've had between 2018 and 2023, which might be less streaming at the end, more streaming. So it'll basically try to, everything will be averaged out across the regression period, rather than reflecting where the company is today. So whenever a company is changing, whether it's business mix, or its debt to equity ratio, regression beta will, even if it works and it gives you a number that is actually the right number, will be able to reflect the average over the period rather than where you are today. Okay. So I can't do this yet for you, but as I look through your reports, one of the things I'm going to look to see is what you'd run the regression and then you do the alpha, the beta, and the R squared. And then I ask you to come up with the cost of equity. And that's where I make the pitch of, hey, you want to use bottom-up betas. You know, one of these days, I'm going to succeed fully on that pitch where everybody's going to use bottom-up betas. But there are always these stragglers. And you might be one of the stragglers. I'll pre-specify what you've given. Don't go in and try to fix your report right now. I'm not going to take points off because you used regression beta. But I'm going to tell you what the kinds of rationale that I generally see when somebody says, I have a regression beta and I have a bottom-up beta, but I'm going to stay with the regression beta. Okay? This was in spring of 2023, last spring. 91% used regression betas, 8%, I'm sorry, 91% used bottom-up betas, 8% used regression betas, and 1%, I had no idea what they were doing, right? It's like they had a gut feeling beta. I don't like this beta. Don't do the gut feeling. If you're one of those savants who can sense the beta for a company, I bow before you, but don't show it in this report, no, show, reveal it to others. But when you look at people who pick a regression beta, here are the 3 reasons I generally see. One is, my company is unique. I cannot find other companies like it. In a sense, every company is unique, right? But remember, betas don't reflect the kind of model or distribution model you have. They reflect the business you're in. I remember when Facebook and Google first went public, and people said, there are no online advertising companies. You're right, but advertising is a business. Betas reflect how much companies spend on advertising, not how you deliver that advertising. Before Uber and Lyft came along, there was no ride sharing, but car service was a business. So even though your company might be unique, step back and think about how it makes money. And there are no new businesses. Every business has been around forever. The way it's been delivered has changed over time. So to the first point of unique, just expand your definition of business. Second is, and this is a very common one, I'm in only one line of business. Why do I need to do a bottom-up beta? Remember, bottom-up betas have the advantage of reflecting the mix of businesses, saying if I'm not in the mix. But remember, you get the law of large numbers that that an average beta is better than a single regression beta, even in you're a steel company. I will still take a bottom-up beta from the steel business over your regression beta every single day. And finally, and this is a very common one, my bottom-up beta is too different from my regression beta. In other words, you will use a bottom-up beta only if it's close, which what's the point, right? The entire reason for using bottom-up betas is precisely because you can get different numbers. And when you get different numbers, my argument is go with the bottom-up beta. It is a more reliable indicator. So if you picked a regression beta, used any of those three reasons, as I said, I'm not taking points off for that. But hopefully, as you think about it, say, you know what, that doesn't make sense. So this is the distribution of your betas, your regression betas. So your regression beta, the median is 1.05, the average is 1. I want you to, as I go through the descriptor of your companies, start thinking about what the typical company, so the typical company that you analyze was slightly above average risk, right? That's all. The lowest number, lowest beta, at least according to your inputs, was 0.06, which can happen. You have strange things happen to your company. Remember, it's a regression beta. Strange things happen over the last 2 or 5 years. You're going to get a beta that's really low. The highest beta is 3.11, which can happen if you have a very high debt to equity ratio and your equities become incredibly volatile. So the beta measures how risky you are. If you trust the regression, that regression slope is the beta. Then I asked you to compute a Jensen's alpha. Somebody give me an intuitive explanation. Mike Jensen actually just passed away 3 days ago. Okay, so Jensen, what is Jensen's alpha measure, Claire? Complete, better than expected, given what its risk and given what the market did, right? So it's a conditional expectation. So the market is down 15%, you reflect that. If you're a risky stock, so it's a risk-adjusted, market-adjusted measure of performance. The average instance alpha across all stocks is 0. And you came pretty close. Your median company had a Jensen's alpha of pretty close to 0. Your average Jensen's alpha was positive, which tells you that at least across your companies, you're more likely to pick winners rather than losers. None of you went looking for Bed Bath and Beyond. A lot of you went looking for Novo Nordisk and NVIDIA. We tend to, again, this is a feature, is when you want to analyze a company, you'd much rather analyze a winner than a loser. And that can be a problem in the way we think about businesses, right? We take the winners, we celebrate them, we learn from the winners, but we can also learn from the losers, but there isn't enough attention paid to them. So we pay attention to Uber, but we don't think about the fact that a taxi cab medallion was the way car service was delivered 20 years ago, and that business has collapsed. And your R squared, and again, this is where I had to go in and remove the 3,000, because the way I knew there was a problem is the average R squared came in at like 183%. And I said, I've got to either relearn statistics or something is going on. Your median R squared is about 32%, which is, I think, pretty reasonable. A third of the risk in a typical stock comes from the market. 2/3 is company specific. Now you can see why managers get uncomfortable using betas, right? If you're a manager in a company, you think about all risk. And we're kind of arguing that you should focus only on the risk that is macro or market risk. But the rest of you is screaming, but what about all of the other risk? And the argument is not that it doesn't affect value. It can show up as an expected cash flow, but it's not going to go into your denominator because investors can diversify away the risk. So that's a cost of equity component. You get it either from a regression beta or hopefully from a bottom-up beta. Your equity risk premium should reflect the geographic mix of where you operate. So when I looked at your equity risk premiums, I don't think there were 2 equity risk premiums that matched up. And you should expect that, right? Because even if you're a US company, there are very few companies which get all of their revenues domestically. And some of you spent, I think, way too much time finessing that geographic mix because your company frustrated you, right? They said 71% from the US, 18% from Europe, 11% the rest of the world. And you said, what is the rest of the world? I want to find out what the rest of the world. You probably spent 6 hours on Google search looking to see where Starbucks were in the rest of the world. You got that out of your system. Don't ever do it again. If you have 11% of the rest of the world, just use the global equity risk for that 11%. Remember, ultimately, the effect is what will it do to your cost of equity? Yeah.
Um, just one instance of
Yeah.
gone down the rabbit hole in analysis.
Oh, there every step you could have, right?
My question is advice for the strategy when you're new in an evaluation, or I guess for the process of knowing something that's worth zooming in versus when.
Part of it only comes from doing it, right? So I could have told you it won't make any difference in your cost of capital, but sometimes you have to go through the 6 hours, finesse it, and say, I could have got pretty much the same number if I used a global equity risk premium. One reason I kind of restrain myself from stepping in there is when you learn it yourself, it sticks, right? So that's part of it. The other is we live in a world where you have too much information. None of us should be complaining, I can't find stuff anymore. It's the rabbit holes happen when you go looking without knowing what you're looking for. Never open up Google search unless you have the question you're trying to find the answer for. Don't you have a company? I'm going to go on Google search. You are going to go into rabbit holes. Forget about rabbit holes. You're going to be in another planet before you know it because you're going to get pulled out of your comfort zone. But if you think about cost of capital, you got the cost of equity, which reflects the risk-free rate. So it reflects the business mix you have and the geographic mix and the currency choice. And then you get to your cost of debt. Once you made the currency choice in your cost of equity, your cost of debt has to be in the same currency. This is not about what currencies you borrow in. It's currency choice in analysis is just like a measurement variable, Fahrenheit versus Celsius. You make a choice, you stick with it. The cost of debt, you start with the risk-free rate, the same risk-free rate that you started the cost of equity with, and you add a default spread. For some of you, that choice was easy because S&P or Moody's or Fitch did the default risk assessment. You came up with the rating. For some of you, you had to assess a rating yourself. For some companies, you assess both and they did not match up. For an obvious reason, the synthetic rating that we compute is based on one ratio, interest coverage ratio. It has no nuance. It doesn't consider all the rest of the stuff. You would expect the S&P and Moody's rating to be more informative because they've looked at more stuff. So we have both an actual and a synthetic rating. My advice is don't look for trouble. Just go with the actual rating. Just be aware of that difference because it's going to come back when you do the optimal debt ratio and become an issue perhaps in why your optimal might give you a number that doesn't make sense. So you come up with the cost of debt. Remember though that you need an after-tax cost of debt. And for that after-tax cost of debt, you need a tax rate. Remind me again what tax rate I use? A marginal tax rate. Give me the reason because you're going to get into this argument somewhere along the way this summer, next year. Why do we use marginal tax rates? What is it that we're trying to capture? The tax benefit from interest expenses, right? How does that work? Gandhar? It's not that it's based. You subtract it from your total income. So if you think about where you get the best, if you have 1.1 million income, you have 100,000 interest expenses, you subtract the 100,000 to report taxable income. It's the last 100,000 on which you saved on taxes. So it's not that the effective tax rate can't be different from the marginal tax rate. It's a fact. So both in the levered beta and in the cost of debt, use the marginal tax rate. Where do you get that marginal tax rate? You look at the country in which you operate. If you're a multinational, I'd still probably look at the country I operate because you don't have to borrow in every country that you operate in. You can choose where you borrow. Apple borrows all its money in the US. Why? With the 25% tax rate, they don't want to go around the world trying to borrow money in countries, we get a much lower tax benefit. And for the weights, you use market value weights. Market value of equity is easy, right? For a publicly traded company. Market value of debt is messy. Why? Because even companies that borrow issuing bonds, those bonds are not often traded. You can't look up a market price. And even those companies often have bank debt that's not traded. The book debt is often what you have. And for most companies, using the book debt as if it were market, and be very clear, when you use the book debt, you're not using it because it's book, because you think it's pretty close to market, is not going to get you into trouble. But there are two places or two conditions where the book debt can be misleading. What are the two conditions where book debt and market debt can deviate? One is distressed companies, because when you look at book debt, it reflects what you borrowed, but distressed company, the cost of debt has gone up. So, and the other is if you borrowed money in 2021 and that debt is still on your books. Why? Because interest rates were much lower. And now that they become higher, so it's better to do market debt. But again, on this project, you said book debt. I think my company is healthy. I'm going to use book debt as market debt. I'm going to back off and say, okay, this is again a detail. I don't know, it's not worth finessing. And especially when you see how much or how little debt your companies have. Gandhar? For the maturity, not for the debt. For the maturity, because then the book debt will become the market debt, right? Because when you compute the present value, if I have debt that's coming due, the book and the market debt will converge. Exactly. Yeah. So let's start by looking at how much debt you have. And this is again, as you know, when you think about, Zach pointed out the rabbit holes. Many of you spent a lot of time trying to get the cost of debt right to the second decimal point. But here's the reason it doesn't make much of a difference. These are the debt ratios, the actual debt ratios of companies. Take a look at how many companies have debt ratios less than 10%. In fact, many of these companies, if you didn't capitalize leases, would have no debt at all. It's not uncommon for companies to not borrow money. That's hopefully one perspective you'll take out of the class is when you see a company with no debt, you're saying, where is it hidden? There is no debt. They haven't hidden it away from you. They just don't borrow money. And if you look at the median debt ratio across your companies, it's about 17.5%. Next time you listen to some guy on CNBC talk about how US companies have gone on a borrowing spree. People just make up crap. I mean, US companies, if you look at, whether you look at debt to capital or debt to EBITDA, I've looked, in fact, they look healthier now than they did 20 years ago. So if you're going to make an argument about US companies doing unhealthy stuff, at least base it on facts. And you can see that in the companies you pick. There is one company, though, and I'm curious how it made it into the money-making criteria, which had 95% debt. Right? I think I know what the company is, and I think it's actually pretty close to the actual debt ratio. Shows you how high the debt ratio can go before you tip over the edge. So that's your cost of capital. It reflects not just your overall cost of funding, it's your opportunity cost looking across the whole company. And then I said, what kind of projects does your company have? And this is a really difficult question to answer. Why? We don't have insight into individual projects. Disney doesn't invite you and say, take a look at our theme park numbers, right? We're looking at a company from the outside, and what you're getting is the income on their portfolio of projects. Some of them might break it down by business, but they're the exception rather than the rule. So we look at accounting returns, and we hold our noses while we do it. And many of you notice as you compute accounting returns that strange things happen. If you step back though and think about in a world where accounting earnings actually made sense and accounting book value actually made sense, there are two ways you can compute returns. One is you can look at returns through the eyes of equity investors. Net income divided by book equity, that's return on equity. The other is to look at after-tax operating income, income to all invest in the firm and divide by invested capital. Invested capital is book equity plus book debt minus cash. This is the only place in finance we go back to book value. Everywhere else, market value. What are we trying to do? We're trying to answer the question, are the existing projects for this company good or bad projects? So tell me some of the issues you ran into in terms of computing accounting returns? Yes. Yeah. So that lowered income, but what did it do to your returns? It made so the earnings became negative because of depreciation amortization. That can happen, right? Accountants can take big charges. You have a restructuring charge. No, yes, right. And in fact, it drives it down not just low, but how many of it had negative book equities? And it freaked you out, right? Because you say, what does that even mean? The accountant's telling me my company's worth minus 5 billion. Tells you why balance sheets matter less and less, because you can have, I mean, Apple's book value of equity is going to become negative in a few weeks. You know why? Because they're buying back $110 billion worth of stock. And when you buy back stock, it effectively lowers your book equity disproportionately because the market value of equity is so much higher. Clear? Not meaningful, right? You can compute an ROE, it's going to be negative, but it's because you have a positive numerator and a negative denominator, right? If you then conclude that companies taking bad projects, it doesn't really make sense. It's a numerator that's a good thing. It's a denominator that's causing it. Can the investor, did any of you have negative invested capital? Do you have a negative invested capital? It's more uncommon, but it can happen. Book equity plus debt minus cash. Apple will, again, it's going to have negative invested capital because not only is its book equity going to drop, it still has a $150 billion cash balance. You're saying, what do I do there? Just throw return on equity and return invested capital out. You're saying, then how do I judge projects? I mean, this is just one piece of a much bigger puzzle, right? If I ask you, is Apple picking good projects? What's your sense? Has Apple picked good projects over the last 20 years? Yeah. Do we need an ROE and ROIC to just? No. So Warner Brothers pick good projects. Again, I don't need an ROE and ROIC. Said this company is in trouble. It's picked crappy projects. So sometimes getting that picture of the company and recognizing it's nice to have a return equity and return investment. It gives you a peg. But even without the peg, in fact, the follow-up question I asked you to consider is not just what the return invested capital, return equity are, but what do you think about the future? Because remember, when you earn more than your cost of equity or cost of capital, you have some barriers to entry, competitive advantages. Are those going to last? And with Apple, I think there's an interesting question. Almost all of that high return equity and return invested capital comes from one investment Apple made 20 years ago, which is the iPhone, right? The iPhone is the beast that's carried Apple to a $3 trillion value. Is there more return left in the iPhone? I'm not sure. I mean, I have an iPhone 12. I'm not even tempted by the iPhone 15. What are they going to do? 17 cameras in the back? I can't take a selfie with I can't take a selfie at all. Adding 15 more cameras will just make me even more confused about what exactly I'm seeing on my camera. There is a question with Apple, and you see the market starting to ask it, is this it? Now, Apple might surprise you and come back, but maybe it won't. And that's the assessment that really matters because it leads you into the capital structure, dividend policy, and valuation. So I'm going to report back your return spreads. Remember, I asked you to compute return invested capital, cost of capital, with the caveat that accounting returns are these noisy numbers. Your typical company had a median return spread of 5.22%, and your average was 21.6%. There were some outliers. Remember, we saw this across all global companies. Do you remember what percentage of global companies, what's a median excess return for a global company? A positive number or a negative number? 60%, actually 69% of global companies earn less than their cost of capital. Your sample is clearly different. In your sample, about 61% of companies earn more than their cost of capital. What do you think caused this? One is your search for winners. What else? There was a criterion I added when I listed when you pick projects up front that some of you chose to ignore and live to mourn, which is don't pick money losing companies and don't pick banks. I might be repeating myself, but it's the same thing, right? Banks and money losing companies, I essentially took a lot of the negative excess returns out of the picture. So I'm not surprised. So we've got the investment return section. Then I asked you, what's your optimal debt ratio? And it's true, the spreadsheet kind of got in the way because it kind of came up with the number. But if you look at your optimal, so now this is the optimal. If you remember the actual debt ratio graph, it was all bundled around the 10% going down. Your optimal, 30% was the most. There were a couple of companies, and now which had optimal debt ratios of 90%. Can it happen? Yes. Your market value has collapsed. You have a lot of cash flows to service the debt. But you can see that there's a bundling between 20 and 40% of the optimal debt ratios. There are 18 companies with an optimal debt ratio of 0%. 6 of them were those money-losing companies. And that's part of the reason I begged you, please don't pick a money-losing company, because after you finish the investment, actually, after you do the cost of capital, the rest of the project writes itself, right? Because what's your accounting return going to be if you're money losing? It's going to be negative. How much can you borrow if you're money losing? It's 0. How much can you pay in dividends if you're money losing? Nothing. Maybe you can come back to life in the valuation section. So it requires incredibly creative reasoning to write something interesting for capital structure and dividend policy. But the other 12 were not money-losing companies. These had very low income. They were money-making, but their market value was huge. Remember, the first debt ratio I try is at 10% optimal. If you're NVIDIA, 10% of $2 trillion is $200 billion, right? You're already going to be tipping over the edge. So remember, these are market cap debt ratios, and that can factor into why your optimal is so low. Justin? I also looked at, because you had actual and optimal for the companies, I wanted to see whether the typical, where the typical company, and your typical company is under 11. The average about 11. So basically, I'm just taking the actual debt ratio to the optimal. You had 121 under-levered companies and 72 over-levered companies. Again, if you're going to have a prom, it's better to have the under-levered prom, but that's not something you can pay. On the debt matching, I steered you away from running that macro regression. And of course, you ran it and got good results, all the more power to you, because it's incredibly noisy. The macro regression I'm talking about, you take the firm value, run against change in inflation, interest rates. So nothing else, a neat little exercise, but you get strange looking output, right? So you can't, but you're saying, what do I do then? Remember, there is a much more powerful, in my view, intuitive way of thinking about whether your company has the right kind of debt. Because by the time you get to this section, you should have a sense of, what a typical project looks like. And that's part of the reason I asked you, what does a typical project for your company look like? For some companies, that's an easy question to answer. Home Depot. For other companies, it's more difficult. What's a typical project for Disney? It could be a movie, it could be an addition to a theme park, much messier. But your debt should match up what a typical project looks like in terms of duration, in terms of currency, whether your pricing power. So in this debt section, you're basically asking, what is the right kind of debt? To what purpose? You can compare to the actual debt then, and the debt is mismatched. You're creating default risk that you can be avoiding, and you should try to get that mismatch out of the way. So we finish capital structure, we get to dividend policy, right? You see what the company is paying out. You can pay dividends, but increasingly in the US, you also get buybacks. And I said, you need to compare that to what your company could have paid out in dividends. We called it free cash flow equity, but I actually think potential dividend is a more powerful way to describe it. Free cash flow equity sounds fancy. Potential dividend is, this is what you could have returned. And the way we measure potential dividends comes entirely from the statement of cash flows. You start with the net income, you add back depreciation, you subtract change in working capital, all in the operating, so in the first section. Then you move to the investing section and you selectively pick the investing that actually goes into operations. CapEx, acquisitions. You don't put in investments in financial assets in there because that's where the free cash flow to equity goes. And then in the financing section, you look at debt coming in. That's a cash inflow, and debt repaid, which is cash outflow. You end up with potential dividends. That potential dividend could be negative. As I was looking across your 193 companies, I think 21 had negative free cash flow to equity. Does that mean they can't borrow money? If it was just 1 year, you can get away with it. But if you have negative free cash flow to equity year after year, this company should be returning cash. So first thing I asked was, what percentage of cash returned in your companies? And you gave me the numbers came from buybacks. Across your companies, the median percentage that came from buybacks was 63%. So you're getting pretty much what we saw in terms of that trend line. Most of your companies, if you look at how they returned cash, returned it in the form of buybacks. There were about 20 companies which had only dividends. And at the other extreme, there were about 46 companies that were all buybacks. I'll wager, and this is a graph I've had over time, and that all buybacks grows every year, all dividends decreases every year. I'll wager 10 years from now, if you have this graph, the all dividends will be even lower, the all buybacks will be even higher, because it is a more flexible way of returning cash. And then I compared how much cash you said your company returned to the free cash flow equity. And I know it's a little confusing in there. It said over the latest periods, and you're saying, why doesn't he specify the periods? Because for each of your companies, the answer is different. For some of your companies, you have 10 years of data. For some, 3 years of data. This is the aggregated cash return to the and for your median company, that ratio was about 88%. So your median company returns about 88% of its free cash flow equity. There's a huge amount of variation across companies. If you can see, the average of 200% means there are some companies that are returning 8 to 10 times their free cash flow equity. Huge outliers. You got almost an even breakdown. In 97 of your companies, your cash return was less than your free cash flow equity. So what are these companies doing when they're returning less than the free cash flow equity to their cash balances? No, it's not reinvesting. Remember, free cash flow equity is already after reinvestment. It's just going to the cash balance. So 97 of the companies, the cash balance went up. 96, the cash balance went down. Something to keep in mind when you see rising and falling cash balances. I know we did valuation at the very end, so I'm going to cut you a lot of slack on the valuation because clearly you did it in the last 2, 3, 4 days. But if you step back and think about valuation, there are 2 ways you can approach valuation. You can take cash flows to equity, dividends if you want, project them out, discount them back at the cost of equity, and come up with the value of equity. Or you can take cash flows of the firm, which are pre-debt cash flows, discount them back at the cost of capital, and come up with the value of the firm. Now, there are some loose ends when you do free cash flow equity and free cash flow the firm valuation that I just want to very briefly talk about. The spreadsheet did it for you, but I want to talk about what exactly happened in that black box. When you take dividends and discount them at the cost of equity, you're done. What you get as a present value is the value per share. But when you take free cash flow equity or free cash flow to the firm and discount them back, there's some cleaning up to do. When you value free cash flow equity, the cost of equity, especially if you've not counted in interest income from cash, you still have to add cash. And if there are options in the company, you got to subtract out the options you gave away to management. But when you value free cash flow to the firm at the cost of capital, there's a host of cleaning up you got to do. Because remember, with free cash flow to the firm, your measure of earnings is operating earnings, EBIT. So put simply, any asset whose income is not part of EBIT has not been valued yet. The case of Apple, the 150 billion in cash hasn't been valued yet because interest income from cash shows up below the operating income line. If you're Tata Motors, those cross holdings you have in other Tata companies haven't been valued yet because the income from those cross holdings shows up below. So not only do you have to add cash, you have to add these cross holdings because they haven't been valued yet. And then you subtract out debt. And if you have equity options, management options you've given, you got to subtract them out. Until 2007, I think 2007 or 2008, the bulk of stock-based compensation took the form of options. Today, the bulk of stock-based compensation takes the form of restricted stock units. And as somebody does valuation, I get on and say, thank you, God. It's much easier to deal with restricted stock units, just add them to the shares outstanding. Options are a bit of a nightmare. They're neither here nor there, right? They could be in the money, out of the money. So that's why we bring option pricing models to value those options and net them out, because there's a piece of your equity you've given away. So I want to there are a few pages in valuation I never got to. So let me hit. I talked about valuing Deutsche Bank with a dividend discount model. It's the simplest of all models to use, and you can see why. You focus just on dividends, growth in dividends, and you discount them back at the cost of equity. In 2008, if you remember, the growth rate I gave Deutsche's earnings, given their return on equity and retention ratio, was about 5.4%. And I felt pretty comfortable, middle single digits. I didn't see the crisis coming. So you see my projected net income for the next 5 years. I left the payout ratio at 54% because that went into my growth rate. I get expected dividends for the next 5 years. We'll talk about what happens after 5 years. I take the present value of the dividends at the cost of equity. The 9.23% looks familiar. It's how it's a bottom-up cost of equity for Deutsche. But at the end of 5 years, the world doesn't end, right? The company goes on. But what I've assumed after the 5th year is this company is going to be in steady state and stable growth. Why do I need to do that? Because I need closure. So after the 5th year, I'm going to assume a 3% growth in perpetuity, which in 2007 was eminently reasonable because the risk-free rate in euros was 4%. But when I lower the growth rate from 5.4% to 3%, my payout ratio has to change as well, right? That's a critical component when you do valuation, is when you get to steady state, you lower the growth rate. You got to give the company the characteristics of a mature growth company. So 2 adjustments I made. One is I adjusted the payout ratio upwards because their growth is lower. I said they can afford to pay out more. And the way I computed what their payout ratio can be is by assuming that after year 5, that they would earn their cost of equity, which turned out in hindsight to be a hopelessly over-optimistic assumption, but that is hindsight. So they can pay out more. I also assumed that as a mature company, their cost of equity would go down to 8.5%. So they become safer as a company, as a mature company, and they have a higher payout ratio. My terminal value, the value at the end of 5 years, is I take the dividends in year 6 and discount them as a perpetuity with an 8.5% cost of equity. So we have 2 different costs of equities floating around, one for the first 5 years and one after year 5. There's one final loose end here, right? That value that I'm getting is the terminal values at the end of year 5. I want the value today, so I discount it back. And I want you to notice what the cost of equity I'm using to discount it back at. It's not the 8.5%, but you're going to see this on the final exams as well. When you get to the valuation question, you have 2 different costs of equity. You use the terminal cost of equity to get the terminal value, but to discount it back to today, why do I do that? Why, what's the logic in using the cost of equity for the first 5 years?
Because that's the cost of equity. Right?
You got to live through the next 5 years to get to the terminal value, right? If you're a really risky firm, that present value has to reflect the risk through the period that I've got to live through. Add them up, I get a value per share of 104.88. Stock was trading at 89 euros. Thank God I didn't buy the stock. I should have been tempted, but I kind of left it alone. The stock went down to 7. I don't think it's exceeded $20, 20 euros in the last 10 years. So you can see how much the stock has dropped off the cliff. On Disney, I had a messier problem, right? If you remember, this was a 2013 valuation. And as I do it, I want you to think about what would be different if we were valuing Disney in 2024. Disney in 2013 was coming off a pretty successful time period. Excess returns were positive. Jensen's alpha was positive. So in valuing Disney, I created 2 periods. So in the case of Deutsche, I had only 1 period, right? 5 years and then stable. Here I create an initial period where I kept things at the status quo. Let me explain. I assumed that Disney, at that time, Bob Iger was firmly ensconced as CEO, would continue to be run the way it had been run historically. So I took its existing return on capital. If you remember, the 12.61% comes from session 14 or 15, the historical return on capital. Their reinvestment rate from the most recent year, and I assume they would keep doing that for the next 5 years. My expected growth is 6.8%, the product of the reinvestment rate and the return on capital. For the cost of capital, I left the cost of capital at the existing debt ratio. The reason I emphasize that is when we did the optimal, remember we came up with a much lower cost of capital? I've left it at the existing because I don't run the company. Bob Iger does. And since he doesn't seem to feel any urgency to borrow money, this is something I see analysts do. Use a target debt ratio to value a company. Don't do it unless it's your company. You can't step in and replace an actual because you feel the company can borrow more money. I think eventually pressure will build up on Disney to borrow. So over time, that cost of capital decreases from 7.81 to 7.29%. Not much of a change because it's a pretty mature firm already. This transition phase, think of it as an unknown. I didn't know that, but in year 11, I assumed the company would become a mature company. So I brought the growth rate down to a mature growth rate. But everything else also changed. The cost of capital changed, the reinvestment rate changed, the return on capital changed. And effectively in year 11, I'm making it Disney a mature company with lower returns on capital, lower reinvestment rate, and a lower cost of capital. You're saying, what about the transition period? It's automated. My growth rate for the first 5 years is 6.8%. My growth rate after year 10 is 2.5%. All I do in the year 6, 7, 8, 9, and 10 is go from 6.8 to 2.5 in linear steps. Don't finesse this. It's not worth it. Same thing with the cost of capital. Every number, that transition period is just to get it from where it is today to where it is now. So that terminal value is a big number, but there are 4 things you can do to keep it from running away from you. One is, remember I said you could use this equation only if your growth rate is a growth rate you can sustain forever. And I said that growth rate cannot exceed the growth rate of the economy. Respect that cap. You'll be tempted because you want to make the value higher. Say, can I make it a little bit higher? That's like being a little bit pregnant. I don't think it works. You're either breaking the rule or you're not. This is one of those things where if you mess with, it's easy to start tweaking it, and the next thing you know, you've lost control of the valuation. Respect the cap. Second, remember this is Disney 10 years from now, not Disney today. It's NVIDIA 10 years from now, not NVIDIA today. The returns on capital they will have then will be very different. You see, how the heck am I going to know what it is? You have to tell a story about the company, whether it can maintain its competitive advantage over time. So you have to think about what your return on capital will be. And in this case, I did assume that that return on capital would drift down from 12.61% to 10% as Disney got bigger, entertainment gets more competitive. You have to reinvest to grow. Just because you're a stable company doesn't mean you can stop reinvesting. And for you, that number actually pops out from the first 2. If you respected the cap, and I did by setting the growth rate at 2.5%. And then I said the return on capital is 10% in perpetuity, your reinvestment rate comes out of those 2 assumptions. Remember, growth is equal to So when you get to terminal value, that sustainable growth equation tells you what the reinvestment is going to be. And finally, the cost of capital for Disney in year 10 will be different from the cost of capital today. One of the things I find troubling when I see people doing DCFs in practice is how they get one cost of capital and it stays frozen at that number in perpetuity. That's inconsistent with what you're telling me about your own company in your own spreadsheet. Your cost of capital should change for most companies over time. So here's my Disney valuation based on that input and the story I've told you. So it's a story of the status quo, a relatively well-run company continuing to do what it does. And you see that play out so every number in this valuation comes from something we did in the class. Why is the cost of capital where it is? That beta is the bottom-up beta that we use from the 5 businesses. The equity risk premium reflects the geographic mix. The risk-free rate is in US dollars because I chose to value Disney in US dollars. The default spread comes from their actual rating. The marginal tax rate of 36.1% is the marginal tax rate we've used all the way through. That mix of debt and equity is a market value mix. Equity is the market cap, The debt includes, in 2013, my estimate of the lease debt plus the rest of the debt in market value terms. So that's my cost of capital to begin with. Over time, it declines. My cash flows come from my expectations of growth, 6.8%, and my reinvestment. So the reinvestment is the consolidated effect of net capex, working capital, acquisitions, all the stuff Disney might do over the next 10 years. At the end of 10 years, I put the company into stable growth, 2.5% or 2.75% growth in perpetuity. And that terminal value of 165 billion is the elephant in the room. That's the big number. It's driving my valuation. And it'll always be a big number in a discounted cash flow valuation. Discount back all of those numbers today, I get a value, present value of 125.5 billion for the operating assets. I add cash. You're saying, what non-operating investment? This was the 49% stake. Disney was not allowed to own a controlling stake of Hong Kong Disney. One of the requirements of the Chinese government was that Disney would actually have to settle for 49%. The Chinese government owns 51%. That 49% is not treated as part of the operating assets. It's a separate, almost like a joint venture. So that's the 2.8 billion. I subtract our debt and there's a minority interest. There's other stuff that they've consolidated, a TV station or a TV company in India. So all those things that they control, this is the portion that doesn't belong to them. They get a value for the equity of about this tiny slice of options. It's not a tech company giving out options like they're going out of style. The value per share that I got, and this was in November of 2013, was $63. You know, last year, Disney came very close to that 60, and that is 10 years later in a market that's tripled. That's kind of a scary thought. So if you look at the last 10 years, Disney's gone nowhere. It's kind of run in place. It had a rise, it's fallen off. And that's part of the reason there's so much angst about where is Disney going. So I asked you to value the company, and I will take the numbers with a grain of salt because it happened in the end. You really didn't have a chance to think about your story. So, you know, but based on what you gave me, the median company is overvalued by about 8.7%. The average company is overvalued by about 90%. But again, that's because there were companies that you found overvalued by 300, 400%. Right? The median company is overvalued. And 74 of your 193 companies were undervalued. 119 were overvalued. That ratio I track over time because it tells you the collective optimism or pessimism about the market and what's happening around you. So, now that value reflects the existing management running the company. Right now, what's Nelson Peltz's argument? Disney could be run differently, right? Whether he's right or not, I think people are open to that question, especially after the last few years. So when you think about changing value, boil it down to basics. I mean, one way of thinking of changing value is, can I do something to improve my cash flows from existing assets? That's the first stop. If you're running existing assets inefficiently, maybe you can extract more cash flows. Second stop, you look at growth and ask a fundamental question. Should I even be growing? You're saying, what's wrong with growth? If you're growing and earning less than the cost of capital, I'd prefer you not grow. If you're growing and earning more than your cost of capital, I might ask, hey, could you reinvest more? Are there other geographies, other products? Then you look at the cost of capital, and the cost of capital, you can see that, you know, if you change the debt ratio, you change the type of debt, you match the debt up, you might lower the cost of capital. And perhaps if you're really good about building up your competitive advantages, you can put off the time when you become a mature company. To me, that's what corporate strategy is all about, is building up that period where you can earn more than the cost of capital. So when you go into a company, you're saying, is there something I can do to change the value of the company? Right now, if I've made you CEO of NVIDIA, you probably say, why are you making me come in here? What can I do here? This company looks like it's pretty close to perfectly run. You put those on the table. There are no perfectly run companies. There's some very well-run companies, but every company has a blind spot. Maybe there's a little bit of debt capacity that NVIDIA can use that you might come up with. But the reality is you're not going to be able to move the value of NVIDIA very much. But right now, I'm sure if you looked at Disney, the things you might say, I would do things differently. So with Disney, here's what I did. I said, okay, I'm at a point where I've looked at Disney, and this was in 2013, and there are a couple of things I think they can do differently. One is I think they can use more debt. This is the place to bring in your optimal debt ratio and the fact that the cost of capital will be lower. I said, maybe they can go to a higher debt ratio, lowers the cost of capital. On the investment side, I do think that if they're more selective, I think they need to reinvest less and be more selective. Selective in what sense? The best investments Disney has made in the last 15 years has been buying franchises that other people have kind of let go to waste. Thinking of Marvel, and I'm thinking about, Star Wars. Much as we love George Lucas, and Star Wars was becoming almost at a point where his views were kind of driving out what you could actually do with it. And I'm sure if you're a Star Wars fan, you're ready to fight me on this one. Okay. But the truth is those are two franchises they got for 4 billion, each of which they probably got quadruple the value. What's the worst thing they did? Well, spending $70 billion for those News Corp assets when they wanted control of Hulu, okay? Which was a silly thing to do because you're spending a lot of money. So I did lower the reinvestment rate and raise the return capital, not by a huge amount. They used to earn a 14, 15% return on capital. It's drifted down to 12.6%. I said, with those changes, I get a slightly higher growth rate from 6.8 to 7%, but I deliver it more efficiently. With those two changes put in, the value that I get is 74.91. The value that I got with the original 62.56. The value I'm getting with the changes put in is 74.81. What should I call that difference? They're worth $65 with the status quo. I think if it's run differently, it can be worth 75. It's about a $10 difference. That's the value of control. I know that bankers put a 20% premium. The value of control is the difference between two values, the status quo value and the value of the company run better. But to answer the second question, you need to understand corporate finance. I remember when Carl Icahn in 2013 took an activist position in Apple. And his point was Apple should borrow $300 billion. It'll make the company more valuable, which was stupid. Because if Apple borrowed $300 billion, they'd go into triple C. But he actually assumed they could borrow $300 billion at the prevailing interest rate that they were borrowing money at. This is the kind of mix-up that happens when you don't understand. I mean, I think that if you understand corporate finance, you're going to get much better at valuation because you don't make these changes and not think through what the heck does that mean? When I raise my debt ratio, it makes my equity riskier, my debt riskier. What does it do to your cost of capital? But I think that effectively is where corporate finance comes in. Now, as you went through the project at each phase, you were telling me something about your company, right? When you got to the leverage question, I asked you, is your company under-levered? Then we got to the dividend section. Is it accumulating cash? We got to the valuation section. Is it undervalued? I have a triple whammy list. These are the companies you analyzed, which were under-levered, undervalued, and are accumulating cash. As an acquirer, do you see why these companies look attractive to you? Because you got if one of those three things work for you. I'm not suggesting these companies are all going to be acquired, but they have the pieces in place that if somebody acquires, because remember, the best place to be in investing is to be the shareholder in a target firm when it's targeted for an acquisition, not after, but before. So if you're creating a preemptive portfolio of saying, look, I'm going to take positions. I mean, you might have an ESG problem with Smith & Wesson, but that's between you and Smith & Wesson, okay? But these are the companies that, again, based on analysis, looks like they have all three pieces in place. So you've seen this page before and might as well see it again. Saw it in the first set. How many times you've seen the same page over and over, right? Hopefully by now it has a little more heft to it. Investment principles says go out and take investments that earn a return that is greater than your minimum acceptable hurdle rate. Hopefully by now that minimum acceptable hurdle rate has something backing it up. We measure risk with a beta if investors are diversified, the cost of debt with default risk, and the mix is captured in the weights we put in the cost of capital. for, whether the returns are high. You could already see why if you have cash flows, you don't want to go out with accounting earnings after, especially after entanglements with return on capital and return on equity. The financing mix says go out and find a mix of debt equity that minimizes your hurdle rate. And after dealing with that, you could see it's not a slam dunk. More debt doesn't always make your cost of capital lower, even though it's cheaper than equity. And match the debt up to your assets. The dividend principle says if you cannot find investments that earn your hurdle rate, and even within this class, remember, 40% of your companies are earning less than the cost of capital. For those companies, if they're accumulating cash, as a shareholder, you're going to start with a position of skepticism, which is, why should I trust you with my money? And cash return is basically a way of extracting cash out of a company which no longer has the investments to take with that money. And the fact that Google and Facebook have kind of jumped the process and saying we're going to start paying dividends suggests that they're aware of the problem as well. That you and they, and that's a healthy place to be when companies and shareholders are both on the same page. So if you remember at the start of this class, I did say I had 3 objectives for the class. I'll go back and revisit those objectives, though I might be ripping off scabs on wounds when I do it. The first is I said, this is a class where I want you to think about the big picture. What does that mean? As you get caught up in that equity risk premium geographic mix, I call this elevation. You step back and say, where does that fit in the process? The first time you do it, it's almost impossible to do. You're going to get into every ditch and stay in that ditch and spend days in the ditch. And you come out and say, why did I waste my time in the ditch? It's not a waste because each time you do it, you will get some perspective on where to spend your time the next time around. The second is, this was an applied class. I don't think I introduced a single concept which I did not try to apply. I mean, but when you apply things, you got to be pragmatic. If you're a purist and you come from the theory vision of this is what I need and I will not do it, you will never apply things because there will always be things in the real world that go against you. And I want to ask you, did you have fun? Because this is not the right time to ask that question because clearly this weekend you did not have fun, right? But here's what I want you to think about 2 months from now, 4 months from now, when you read a news story. I mean, I call these aha insight moments where you read and say, I see what's going on here. Build on that because that's really what's going to keep. I mean, my valuation class, I mentioned this Demodrine bot that Vasandar has developed that 20 people in the valuation class are doing valuations, and the Demodrine bot, which has read every blog post I've ever written and looked at every valuation I've ever done, is going to value the same company. And it's a contest to see how close AI is. Each of you has a bot out there. It's coming for you. And your job is to stay ahead of the bot. If what you do is mechanical, you're done. Your bot will beat you. Why? Because who can keep, I have 2,500 pages in my blog. Who can read 2,500 pages and remember it all? The bot can. There are probably 250 valuations I've done that are in the public domain. You could look at all 250 spreadsheets, but your brain's going to be swimming. But the bot can look at that. If your strength is, I know how to look through financial statements, let it go. I mean, this is not a strength anymore. What you're looking for is something you do that your bot will not be able to do. I would love to tell you I have the answer. I'm terrified of how this Demodrine bot is going to do. If it does really well, I'm saying, what's the point? Let it write the blog. Why am I writing the blog? It remembers everything I've written. If it does really badly, I have a different problem. I write my blog, I do my valuations because I want to teach people how to value companies. I'm thinking, what do I do that is going to be difficult for that bot to be able to do? I'll close today with a story, and this is basically, I'm not suggesting I found the magic bullet, but about 8 weeks ago, or maybe 3 months ago, it's been a while, I get an email from somebody in Iceland who read my blog, and he sent a question. He said, I'm valuing a company called Blue Lagoon. It's a spa in Iceland. It's been around a long time, history of making money. And he said, I'm facing a problem. There's a volcano that's erupting and the lava is flowing in the direction of the Blue Lagoon. How do I bring in lava flows into a valuation? Right? I've looked on Google search, how do you bring lava flows? Nobody's done this before. So I read the email, but I had to walk the dog. The dog was getting restless, so I walked by the beach. And as I'm walking, I think about another story I'd read about 23andMe. You heard of 23andMe? Now, what do you send? Saliva, blood, your firstborn, something. You send it to them, and they tell you something about your genetic makeup, or makeup, or they make up something. We had no way of knowing it. And if you've been reading the news, a few months ago, 23andMe had a problem. Somebody hacked into their computer and got the data on all the genetic stuff that 7 million customers. Catastrophic, if you think about it. And then as I kept walking, I thought about the fact that I live in a house in La Jolla, 2 blocks from the ocean, on one of the biggest earthquake faults in California. And I paid $2.5 million for this house. Saying, what do the three things have to do with you? They're all about catastrophes, right? And how we as human beings try to bring it in. And the last one just said, no, here I am paying $2.5 million for a house that can be in a hole in the ground or a tsunami or under a tsunami anytime soon. And I didn't build it in. So it was 3 mile walk, nothing else to do. I let the ideas clatter around. And when I got back, I wrote a piece on catastrophes with these three very diverse stories kind of playing out of, this is what I think about catastrophes. This is why, as human beings, we're bad at building catastrophes in. And if you have a catastrophic scenario, you don't think about the financial implications. The example I gave in the blog post is when you watch Mad Max Thunderdome, how many times do people check their portfolios in the movie? In an apocalyptic movie, do you ever say in an apocalyptic? Okay, there you go. Yeah. But basically, in an apocalyptic movie, your first instinct is survival, right? So if I tell you 20% of the world, you're going to be in a catastrophe, you don't build that into your valuation of NVIDIA today because you don't care that 20%, it's not. So I think as human beings, we take catastrophic events out of the process, not because we're being irrational, but if you brought them in, we'd never sleep. If every night, oh my God, an earthquake could come or a tsunami could come, I would drive myself crazy. But my point is, those are three very different stories, but as human beings, that's the strength we have. But it's something we're losing because, before Google search came along, this is the only way you could connect things, right? You basically, I think we're losing that as it gets easier and easier to look up answers. So my advice to you is the next time you have a question, don't be in a rush to get to Google search and check out the answer. See if you can reason your way. Don't do it if you're looking for the location of a restaurant. You can't reason your way there. Use Google Maps then and get it done with. But I'm thinking about some question about taxes or tax policy or where the market's going. Don't be in a hurry to let somebody else's thoughts intrude in there. So I'm going to leave you with that because, you know, I will see some of you in my valuation class. I teach only in the spring. Why? Because I don't like being in New York much of the year. So I don't want to be in a hot, humid summer. So I'll leave on May 16th. I have my plans all set out. So that's why exam comes in. I'm going to grade it. I'm going to get it back to you. And I'm out of here May 16th. And I'll be back around January 22nd, 23rd of next year. In the meantime, what am I going to do? Probably walk my dog. I mean, this is a good excuse for me not to work, right? Because you got to keep an empty mind for this basic stuff to happen. So I will see you at the exam, and and when you do send in your projects, please CC everybody in the group. Now, that way, when I reply, I can reply to all. You all get your graded project back. So hopefully I can start on the projects this evening. I'm going to start the valuation projects first, not because I prefer the class, but they're more seniors in the class. They need to get out of here. And I don't think they're lying awake saying, well, I failed the class, but still it's good to know you did not fail the class. And then I'll move to corporate finance. So sooner or later, you should be getting the projects back. Thank you. Oh, one more thing. You do know there is a CFE, and I have a very selfish reason for asking you to fill out your CFEs. If you don't fill out your CFEs, guess what happens? You can't check your grade. And if you can't check your grade, I know exactly what's going to happen next. You're going to email me and say, I can't check my grade. Can you tell me my grade? By then I'll be in San Diego walking my dog. So please do your CFEs, get them out of the way. No. Thank you.
I was double checking my number
Mhm.
this morning.
Just change. That's okay.
We watch you like